On today's InvestTalk, we benchmark your 401k balance to the average person of your age. Then we break down the massive spike in volatility today in markets. We answer questions about SoFi, Denison mines, and EQT and more. And at the end, I look at whether following investment flows can give you an edge.
This is InvestTalk, independent thinking, shared success.
Now, my main focus point today concerns this story. 2024 average 401k balance by age. Have you saved enough? And this is a report from Vanguard, and they analyze millions of accounts, and they title the report, How America Saves. So let's take a look at some of the data. Now, the average 401k balance this year was $134,128, up from $112,572 last year in 2023. So pretty sizable increase, obviously, because equity balances are higher. Now, that is the average, well over $100,000. But the median, remember, the median is that middle account, not the average, the middle. And that is only $35,286. What it shows you is that there are some pretty big 401k accounts that are dragging up a lot of these very small 401k accounts. So what that tells you is either number one, people aren't saving enough, and that's certainly possible for some people. But number two, probably more commonly, is that they are abandoning their 401k, meaning they leave their job and they forget about it. That happens all the time. And it's the number one mistake people make with their finances. And we help them roll them over into an IRA. That's pretty much the number one choice you should almost always make 99% of the time. There are some one-offs, but 99% of the time, you should be rolling that into an IRA and opening up your investment options, etc. Okay. Now, according to this study, I'm going to list off the average 401k balance by different age groups. Now, under 25, $7,351, but the median is only $2,800. Between 25 and 34, $37,557, with the median just shy of $15,000. Between 35 and 44, $91,281. The median all the way down to $35,500. If you're 45 to 54, the average is $168,646, but the median all the way down to $60,763. You can see as you get older, there's some older people that have accumulated some really big balances, dragging this average up. Between the ages of 55 and 64, $244,750 on average. $87,571 is the median for that age bracket. Now, 65 and up, those that are typically on the brink of retirement or in retirement, $272,588 is their average balance. Now, that jump isn't as high because a lot of people continue to probably take money out. So that's where you're at. And the median on the 65 and up is only $88,500. Now, how do you think about this, okay, based on your age group? Now, if you're in your 20s, you have time on your side. A lot of those people, right, 20 to 29, shall we say, you probably only have roughly $10,000 or so in your 401k. That's okay. And you can say 403b, whatever type of retirement account we're talking about. But the point in that age bracket is just creating good habits. Is you haven't established your life, so you have a lot of other priorities. You're not in a super high tax bracket, most likely. So getting that tax deduction isn't as important. But it's the habit of putting money in and trying to get the full match, okay? Now, when you get into your 30s, that's when maybe you've built a little more comfort in your life, you have a little more flexibility, and you start to increase your contributions annually, hopefully along with a raise so you don't feel it very much, right? Now, you get in 40 plus, that's when you aim to maximize your contributions, right? Getting that full employer match, obviously, like you should at any time, but take advantage of maybe the full amount you can put into your 401k. You might be in a higher tax bracket, hopefully, so you get that big write-off, and that's always great. And then you also start thinking about, from an investment perspective, what type of risk you should take. You're not 20 anymore, so you don't have decades left, but you have maybe a decade or two until retirement, which means that maybe the risk tolerance should come down a little bit. And the same in your 50s. That should probably come down a little bit more, depending on who you are, what your goals are, how long you're going to work for. But most importantly, in your 50s, it's catch-up contributions. You can put even more in your 401k and IRA in your 50s and beyond. And so starting with that is certainly very, very important. And that's also when you want to probably engage with a financial advisor of some type. That's kind of where most of our clients are in that 40 to between 40 and 60 that reach out to us. Obviously, we've had a lot for many years and that are older, but the new clients are coming on board usually between that 40 and maybe 55 range to up to 60. And so that's when you can't just rely on the tools that the 401k is going to give you. You really want to reach out to somebody and develop a financial plan. We actually manage 401ks now as well. So that's super exciting. Where they're at, still making contributions, et cetera. So that's really cool. So if you ever want to engage with us on that, don't hesitate to reach out. So that's how you think about it from different age brackets. Now, based on income level, there are different numbers as well. So if you make over $150,000 or more, the average 401k balance is $336,470. But if you make less than $15,000, it's only $24,000, obviously. So you would imagine the more money you make, the more money you're able to put away. Now, based on men versus women, men average 401k balance $157,489. Women, $112,401. So certainly that fact that women make 86 cents on the dollar of every man, that's probably a contributing factor there. Now, and that's actually tougher because women need to typically live longer. They need more long-term care than men. And so they actually have tougher times developing a successful financial plan. Now, let's look at it based on industry. I thought that was interesting. The highest average balance by industry: agriculture, mining, and construction, $185,000. Finance, insurance, and real estate just behind that, about $184,000. And then media, entertainment, and leisure, $178,000. And media, entertainment has the highest median balance as well. So a lot more people have those higher balances there. So pretty interesting study. I always like to look at those and give you a benchmark of where you are at. Right. Now let's take a look at the market today. It was a very red day, but we did close well off the lows, but it was fairly broad-based sell-off. I mean, you had small caps down 2.82%, but the broad U.S. market was down a little bit less than 3%. If you're looking at the Morningstar style box from value to growth to large, mid, and small, everything was down anywhere between 2 1/3 to almost 3%. Okay, so there was nothing that was kind of spared. So don't feel bad if your portfolio was red. Everything was red. And this is what happens when you get forced selling. It's called correlation goes to 1. And you sell what you can, not what you want to. And that was today. And typically those are days that gives you at least a short-term bottom. And it's usually indicated by the VIX. So the VIX did spike up to, what was the high today? 65.73. It did settle in at about 38.57. But that 65 number was the highest number on the VIX since COVID. Okay, COVID peaked out around 85. So this peaked out around 65. So over the last 20 years, the three most volatile markets have been the 2008 financial crisis, COVID crash, and this one. But once again, this typically does mark at least a short-term bottom. Now, that doesn't mean that it has to hold here for this pullback, okay? What it probably does mean is you get a bounce. Now, you do get a bounce intraday. We closed about the middle of the range for the day, which is okay. We'll see what kind of follow through we get to the upside or downside tomorrow. But we did hit our first support zone. If you watched my video over the weekend, I talked about how, we were getting to support, but the major support was right around between 51.25 and 50.75. and we hit a low today on the S&P at 51. No, that was the open 51.19. So we got into that zone and got a little bit of a bounce. Pretty high volume. Once again, the VIX was spiking. So this is a scenario that should give you some sort of a bounce. How strong that will be, we shall see. Now, what I said in our video was, in my video over the weekend, which you can find on our YouTube channel, is that I think we'll get a bounce soon, and then we'll make another low later in the quarter, maybe early fourth quarter, and that would set up for likely a fourth quarter rally. And the reason I say that is because, first of all, seasonality, positioning, the market was way offsides. It needed a break like this. But ultimately, when it comes to the broader economy, things, yes, the labor market is slowing, but really, if you look at restaurant traffic and lending, it's still pretty solid. Especially look at bank credit, for example. Remember, there are two main factors, and are there more dollars going into the system being created, or are they being taken out of the system? Now, number one is, are banks lending? That is always number one, because that's what 2008 was, right? All the banks seized up, they stopped lending. That was a big deflationary bust. But if the banks are extending credit, that's putting more dollars into the system. They're the ones that actually produce most of the dollars in our economy. And so it actually inflected very negatively back a couple of years ago. Let's see, let's go to a 5-year chart here. Yeah, it went negative in July of last year. So a little over a year ago. Bank credit was negative year over year. But as of March of this year, it turned positive year over year. So, and then if you're going to get Fed cutting cycle, that is also going to really ignite likely this bank credit cycle, positive bank credit cycle. So that's certainly something to watch. And then government surplus and deficit, they're another factor that could put more dollars into the system or not, as you saw during COVID. And the deficit this year is not growing dramatically. It's going to go from about 1.4 to 1.5 trillion, but still inflation adjusted, that is positive. And so you have those two main drivers of liquidity, of money going into the economy. And it's hard to see a major, bear market, 20-25% drop in equities, unless you saw something nefarious or bad inflecting with those two numbers. So that's where we're at. I don't think this is the time to panic, but still could be better buying opportunities as the quarter goes along.
Hey, Justin. Hey, Luke. Long-time listener, first-time caller. Question about CDW. Been on my watch list for a little while. Had a little run-up. Deep drop recently. I feel like it's a good buy point. What do you think? Thank you.
All right. Looking at CDW, provide IT, hardware, and software solutions to customers in the US, UK, Canada. Here's the issue, is growth is now negative. Last 2 quarters, revenues fell mid-single digits and earnings fell low to mid-single digits. So that's not good. And it's trading at about 22 times earnings. Even if you look based on forward-looking earnings, about 20 times. Am I going to pay that much for something that has negative growth expectations? This year, earnings are supposed to go up 1%, but those estimates are coming down. So I just don't get excited about this. They have a good balance sheet. They have pretty good cash flow, but and good profitability. I like that. But if you look at the multiples it's trading at, enterprise value either around 17 times, that's slightly above average from its history. And it's inflecting negatively in earnings. And then the technicals today just broke below the May lows and the July lows. So this looks, from a technical perspective, it wants to take that next leg lower, which frankly is probably the 200-week moving average, right around 187. That's at 206. So I still think there's another 10% drop from here before this gets interesting. And then I'd want to see those earnings estimates, once again, inflect positively as opposed to what they're doing now, which is analysts continue to bring those down for this year and next year. So I would keep on the sidelines. Interesting name, good profitability, good cash flow. That's good. But timing-wise, not a great time at the moment. Thanks for the call. Now let's go talk to Rob in Santa Clara looking at ADX, which is the Adams Diversified Equity Fund. Do you own it or looking to buy it, and what do you like about it?
Well, a couple things. I noticed the high was around 2250 in that area. Mm-hmm. And, with this market pullback, I was thinking, if it gets down, 10, 12%, that might be a good entry point. It pays, from what I gathered, close to a 6% dividend each year, based on the monthly market price. And, it doesn't seem all that volatile. And I looked at their, holdings. They have some really nice holdings. I was just wondering, what you think of, kind of easing my way in to this particular stock.
Well, first off, it's not a stock, right? This is a fund, and it's a fund,
closed-end fund, yeah.
Yeah, it's a closed-end fund.
Right.
Now, the good thing I like about it, it's a lot of closed-end funds, they operate with leverage, and that makes them very risky. Especially a lot of people chase the yield with bonds and a levered bond closed-end fund, and a lot of those I don't like. But this doesn't have any leverage, but it's all U.S. equities. And if I look at the breakdown of the sectors, it looks a lot like the S&P, to be honest with you. It has a little more technology than the S&P, which I'm not a fan of, and a little bit less industrials. But besides that, the weighting is almost spot on. So they're obviously hugging the index in some way. Do you know how they're getting that yield? Do you have any insight into their strategy? And because it looks so much like the S&P, like where is that yield coming from? Are they selling covered calls? Do you know what? Or are they only buying the dividend-paying stocks? Do you know what it is?
No, I don't. But from what I've researched, it seems like each year, especially at the end of the year, they give you a nice dividend, sometimes $1 or more, and they try to average 6% per year.
Yeah. So that's the thing here is it isn't a dividend, okay? And a lot of people get confused with this because it's paying out a distribution, and a lot of people think that all distributions are income, and that's not true. A lot of times they are capital gains distributions, and that's what these are. They're capital gains distributions. They did that in November of last year, and they'll likely do something like that again. Even the last dividend or last distribution, 35 cents was income, and almost 9 cents was long-term capital gains. So from a tax perspective, this is not very tax efficient, and you're not getting your normal type of income that you're thinking. Okay, so I would not be buying this for the income. This is not. It looks too much like the index. If you want a distribution of the S&P, just buy that. It's going to be, and you can go buy an index fund that has much lower fees. Remember, this has a 61 basis point cost to it, and I think people are getting looped into the dividend. And as I always say, don't chase the yield. Chase good businesses, good portfolios of good businesses, and don't just look at this shiny dividend. Look underneath the surface. I don't see anything really special here. It's just an expensive way to get very similar exposure to the S&P. So just buy the S&P and forget about the dividend. Dividend shouldn't matter.
So you think just buying the S&P is?
Yeah, I mean, obviously, I don't love the makeup of the S&P because of very high tech weighting, a lot of overvalued names, market structure issues that you're seeing right now in the market. And this looks a lot like it, right? The top holding is Microsoft and Apple, Nvidia, Amazon, Alphabet, Meta, right? This looks a lot like the S&P. And sure, there's some differences, but I'd have to do a deeper dive on what they're doing here, because on the surface, just looking at these numbers, it doesn't jump out at me that this is anything special. So unless you can come at me with some sort of special thing they're doing that has some durable staying power to it, then I would just say buy the S&P if you want this type of allocation. Now, if you want income, there are other better, more sustainable income portfolios, closed-end funds, mutual funds, ETFs, et cetera, out there than this one.
Well, I appreciate your input.
No problem.
One other quick question, if you have time.
Sure.
Do you think, kind of putting some money in the next few days or weeks
I think
is kind of a good strategy?
I think the market in general is going to go through a rougher period seasonally. August, September are seasonally weak. We came into this time period where there was over positioning, especially in those Mag 7 AI stocks, and that's coming undone. We expected, we said this to clients in early July, that this would be a more volatile period. Where the ultimate bottom is, could this be it? Sure, it could be, but more likely it's later in the quarter. The timing of that is never easy. Never, no one's going to be able to tell you exactly with high confidence that this is the bottom. But I still think there's a bit more volatility over the next 2-3 months. Thanks for the call. Let's go talk to James in New York, looking at EQT, which is EQT Corporation in the oil and gas space. Do you own it or looking to buy it?
I own it. I've owned it for some time. I haven't really enjoyed much capital appreciation on it. It's under 3% of my portfolio, and I'm just thinking at these levels, might this be a good accumulation phase that might pay off later, long term?
Well, EQT is a independent E&P company, about an $18 billion market cap, and they mainly operate in the Appalachian Basin, shale plays in the Appalachian Basin, and they mainly produce natural gas. Natural gas is 94% of their production, and I think that's kind of the major issue is that natural gas just continues to plumb to new lows, and EQT is underperforming, and because of that, EQT is underperforming the broader space, the broader oil and gas industry. And so that's what worries me is, we have some natural gas plays where they're holding up much, much better than this one, have a better balance sheet than EQT. And so I just think you have better options out there, to be honest with you. We've looked at EQT amongst other oil names, and it's not a bad company. It's just, kind of very middling in its quality of its balance sheet, its assets, its profitability, et cetera. So I would be actually looking to trade this out for a better quality name, once again, with better balance sheet, maybe a bit more diversity in their revenues as well. Being so tied to natural gas is very difficult. 94% of their production is in natural gas. So while I like adding to oil and gas plays down here, I would rather have a higher quality name that also has some oil exposure as well.
Okay, thank you much.
No problem. Thanks for the call. Now let's keep things moving and play another listener question from 888-99-CHART.
Hey, Justin and Luke. This is Josh in North Carolina. Called with a question about a coal company I'm looking at, HCC, Hotel Charlie Charlie. It's one I've looked at the fundamentals. It looks okay. Just wondering if I wanted to add this to my portfolio. This is a particular coal that they mine that is very specific to high-quality steel, and I just wanted your opinion on it, if it was worth it to get in now. I've noticed the market today took a dive on a lot of these stocks, and just wondering if you like the company and what might be a good entry point. Enjoy the show. Thank you very much.
All right, looking at Warrior Met Coal, HCC is the symbol, $3 billion market cap, so small cap name. Has pulled back recently with the overall market from the mid-70s, now down to around $60 in change. And historically, these type of companies, they have issues with getting good pricing on their product. But I'll take your word for it. But it sounds like they have higher quality coal that goes into specialty metals, And remember, this is met coal, and that's there's thermal coal that's burned for energy. Met coal is burned to typically produce steel. And so if they have a better one, then I love that. Now, their profitability is very good, returning equity 22%. The 5-year average is 29%. So I'm a fan of that. The technicals are good, making a series of higher highs and higher lows. They have net cash on their balance sheet. Enterprise value to EBITDA is only 4.2. That's very good. What are they doing with that cash flow? Are they buying back shares? No, they're actually issuing shares. I worry about that a little bit. But overall, I don't mind it, to be honest with you. The technicals are fairly solid. And, this is an area where there's not a lot of love, but you can get some great values in areas like that. So I'm going to give HCC Warrior Met Coal a thumbs up. Now, I hope you've been telling your friends that our audio podcast is available in video form over on our YouTube channel, where we get questions submitted via the comment section. And this one came in from Widam Savad. ACMR looks very cheap. Am I missing something? ACMR. This is a name that has fallen from the mid-30s back in March. Now it's at 14 and change. So you're talking about down over 50%. But it is a small name. $930 million market cap, so sub $1 billion. Certainly a small cap. And its earnings were growing. They're up 96% last year, but this year is supposed to be down 4%. Now, what do? They manufacture and sell single wafer wet cleaning equipment and products for the semiconductor industry. There we go. So it's in the semiconductor equipment space. And obviously this is very interesting that this is falling. And it fell well before the broader SMH. SMH is the ETF, semiconductor ETF, which peaked roughly a month ago. And, this was maybe a leading indicator that might be a problem in that industry. So I do worry a bit about the technicals are definitely poor. Return on equity is about 9%, not great. Their balance sheet is solid. I like that. Their free cash flow is negative though, negative $1 million 30 on a $1 billion market cap. That's pretty bad. So yeah, I'm not a fan. The technicals don't look good, and the growth is slowing and turning negative. So I'm passing on ACMR. It's definitely not a bargain. Okay. Now let's quickly play another question now.
Hi there, Duncan from New York. I'm actually going to talk about stock ticker SoFi, SOFI. I'm part of a different service, kind of like a growth stock service, and I'm just kind of curious what your analysis is on them. From what I'm reading, from what they showed me, net revenue was about 20% year over year to $599 million. They used adjusted EBITDA, and I know that on the podcast you said that adjusted EBITDA should be the worst tool to look at, so I just wanted to confirm if that was still true. But I also just overall want to see what do you think the stock is? It definitely does seem like it's starting to head towards profitability, but I just want to know your 2 cents. Thank you very much and have a great day. Bye.
All right, looking at SoFi, and this is a name that peaked out in August of last year around $11. Actually, let me zoom out. Did it peak even higher than that? Well, it peaked out back in 2021 around $24, and then it rallied in late 2023, peaked out, around $11 and change. Now we're at $6.54. And the issue here is, once again, it's a growth stock. It's growth at all costs. And, I always question companies that haven't been around very long and are sponsoring stadiums. I think of SoFi Stadium here in Los Angeles. New companies that do that, it's a red flag to me. It's a red flag. You haven't gone through different business cycles. You don't have the strength of a business to be wasting billions of dollars on some stadium rights. I just think it's just history says it's a bad sign. Okay. And look at the chart of this, just continues to go down and down and down. And yes, they're getting closer to profitability, but return on equity is still negative. The free cash flow is still negative by $2.7 billion. Okay. And then if you look at shares outstanding, that continues to go up as well. About 2021, there's about 800 million shares outstanding. Now we're approaching 1.1 billion. So the technicals are poor. The business is poor. Who cares if there's growth if it's not turning into profitability? You run from this name as quickly as you can.
Hi, Justin and Luke. I was talking about stock Denison Mines, ticker symbol DNN. It's a uranium exploration and development company. They operate out of Canada. I just want to get your thoughts overall on the stock and what you thought of it. I already own a considerable amount, and with the recent dip, I'm thinking about adding more. And just what do you think? Do you think that's a good idea? Thanks.
All right, looking at Denison Mines, $1.4 billion market cap. It has pulled back, and it's into support. I have to say that. It's about $1.50. It pulled back, peaked near $2.50 just a couple months ago. And the whole uranium space pulled back as well. Now, I do think it's more of a seasonal dip. And if you really like the name, you want to take a high risk. And that's what this is. It's a uranium miner that produces very little revenue. And it's a lot about big promises on the mines they're exploring as opposed to actual results. So that makes it extremely high risk. I rather own the bigger companies. That's what we own for our clients. But it depends on what type of risk you want to take. If you want high risk, this is the name for you. Thanks for the call. Now, lastly, let's talk a little bit about money flows. Money flows. And a lot of people, they try to chase the money, meaning they read that, money was going into this asset class, or this big investor was buying this particular company, and they think that they are gaming the system by buying into that sector or those names. But there was a recent study, and basically it showed that if you don't get it in real time, you don't get that data, that inflow and outflow data in real time, there's no real edge that it gives you. Okay, reacting to last month's flow numbers, which is typically what you're getting those a month or two after it actually happened. Okay, now the data showed that if you're looking at real-time numbers on large cap stocks, when money's going in an average month, it returns 13.64%. In months where there's outflows from large cap stocks, the average annualized return is 2.06%. So still positive, but a big difference, about 11.5% difference there. And on the small cap side, it's even worse, mainly because of the lack of liquidity of some of those smaller names. But the average annualized return in the months where money is going into small caps, nearly 23%. In months where money's coming out of small caps, down 12%, negative 12%. So a 35% gulf in the small cap space. So not having access to real-time inflow of data is a big problem, especially for the average investor. Because if you look at the same data set, but just delay it a month, your average annual return by reacting to last month's data, if it was inflows, it would be 10.6%. This is on large caps. But if it's outflows a month ago, actually this month's return is 12.25% positive. So it's actually worse. You don't want to follow that. You actually want to fade that. If it was if a month ago money was coming out, you actually want to buy that more than sell it. Okay. So flows matter a lot for returns, especially in the short term. And so that's why you don't want to get in the habit of reacting to data that is just old. Even though it may, a trend is your friend type of thing, but that's not always the case with inflow and outflow data, because there's sentiment shifts, there's news events that can cause people to pull money in and out. There's obviously economic impacts that could get people to move money in and out. And so if you're trying to follow the money, make sure that it's live, that it's real data, that it's not 30, 60 days old, because that doesn't really help if it is. Okay. Well, that about does it for this episode of InvestTalk. I thank you for tuning in and liking and subscribing to our YouTube channel. So don't hesitate to head over there. There's so much that you can glean from my weekly videos. Obviously, we share our charts on that when we analyze stocks. You'll see kind of the trends that I'm looking at. It's one piece of the data that we look at, but it's an important one. It gives you a good overview of what's happening with the company. So I'd really encourage you to head over to our YouTube channel and once again, subscribe there. Now, that about does it. Like I said, for this episode of InvestTalk, get yours anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night.